Bankruptcy. For investors and traders, that word usually does not inspire confidence. However, as described by Joel Greenblatt in his book, You Can Be a Stock Market Genius, bankruptcies are not always a bad thing. He writes that in some cases, a business is too cyclical to make regular debt payments. In other cases, over-optimistic projections and too much debt combine to bankrupt an otherwise good company. It is these attractive but over-leveraged situations that create the most interesting investment opportunities. For the purposes of this video, we will talk about a successful trade that Greenblatt made in a company that was emerging from bankruptcy. So sit back, relax, and enjoy. I'm Nick, and this is Great Trades Revisited. The company that Greenblatt invested in was called Charter Medical Corporation. In December of 1992, Charter Medical Corporation had been out of bankruptcy for a few months, but it was still considered an orphan stock. Now, according to investinganswers.com, orphan stocks are stocks that investors and analysts tend to ignore. Also known as wallflowers, orphan stocks usually are not outstanding market performers, but occasionally, the reasons for becoming an orphan stock may not be apparent. Charter's stock was brought to Greenblatt's attention when it was trading just over $7 a share. At that price, the company seemed to be valued well below its competitors. In terms of the actual business, Charter Medical Corp operated 78 psychiatric hospitals along with 10 conventional medical hospitals. The company's debt load, although reduced substantially in the bankruptcy proceeding, was sizable. However, this leverage greatly increased the upside potential for Charter's stock. As a side note, this debt resulted from a leveraged buyout and major capital spending program. It is also important to note that the company insiders had a significant stake in the company through stock ownership and options, and this is usually a favorable situation when investing or trading on the long side. In looking further back, the main headwind for Charter before the bankruptcy had been insurers and managed care providers who wanted the company to bring down their costs. In the 4 years leading up to the bankruptcy, the average length of stay in one of Charter's hospitals had fallen from 30 days to just under 20 days as a result of the pressure from the insurers and managed care providers. This impacted revenues and cash flow in a negative way. As well, Charter's debt had increased to over $1 billion at this time due to the leveraged buyout and capital spending program. As a result of the reduced revenues and greater liabilities, the company could not meet their interest obligations, and this led to the bankruptcy. In late 1992, when Charter was finally out of bankruptcy, Joel Greenblatt had taken a closer look at the company and determined that Charter should be trading closer to $15 a share rather than the $7 it was trading at during that time. So what may have caused the price discrepancy? Well, Greenblatt states that this could have resulted from multiple reasons, including Charter having greater exposure to the psychiatric area than comparable companies, Charter's degree of leverage, and a lingering stigma as a result of the bankruptcy. However, to Greenblatt, these reasons did not justify the huge price discrepancy. According to the company's earnings performance for the year ended September 1992, Charter's business looked to be stabilizing post-bankruptcy. Charter's plan was to control costs, to step up marketing for new patients, and to increase its outpatient psychiatric services. It was hoped that these moves would counteract the decline in revenues caused by the trend towards shortened hospital stays. As well, Charter looked likely to earn up to $3 in free cash flow per share. Based on these factors, Charter looked cheap on an absolute basis and relative to its peers. All of this together caused Greenblatt to be long the stock at $7 per share. Lucky for Greenblatt, things went well for Charter over the next year. Costs were contained, patient admissions increased, and the outpatient business continued to grow. And the conventional hospitals were sold for a good price. By the time Greenblatt sold his shares, the stock had increased from $7 to roughly $21, and that is what I call a great trade. Now, before I let you go, I want to note that Greenblatt makes it very clear that investing in bankruptcies can be very risky business. In his book, he seems to favor other event-driven strategies such as using leaps options and investing in spin-off situations. However, I thought that this story of a successful bankruptcy trade would be an interesting addition to this video series. As always, thank you to everyone who made it through the video. Don't forget that liking and subscribing are never expected but always appreciated. For now, take care, and I'll see you in the next video.